Ladies and gentlemen, breaking news. We finally found the dude who lives in New Hampshire. Shane Carter, what's up?
What's up, Kenner? How you doing, buddy? I was
Oh,
hiding
that's
under a rock and you found me. Thank you for finding me.
you're one of the only dudes I've ever met from New Hampshire, man. And this is going to be good. Obviously, you do real estate. You know our market. All the people who are going to be listening and watching are real estate investors, usually pretty big real estate investors. So, give us one tip. Give us one tip about real estate that you have found useful to making you rich.
Oh, yeah. So I would say one tip.
Let's just start off with one tip, then we'll get into it. Yeah.
Let's start with one tip. One tip, um, focus, right?
Focus. Give me. What do you mean by that? I like that. What do you mean?
What do I mean by
Where were you
that?
20 years ago?
20 years ago, I was all over the place, right? Like most young entrepreneurs, 30-year-olds,
Mm-hmm.
I was not super in touch with who I was as a person, right?
No.
I was grinding and spinning my wheels and really just going for all kinds of shiny objects and now I made money at everything, right? I made plenty of money,
Mm-hmm.
but I didn't make real money until I
Yeah.
got really, really focused. And also, I screwed up a bunch of relationships by being spastic and all over the place and
Huh.
not being calm and centered. And so now I'm at this wonderful place in life where
Huh.
everything's balanced and I have better relationships and I make a ton more money and I work way less.
That's the right there. Work-life balance. That's so important. So important.
Yeah. So it's
Mm.
a great spot to be. But it took me a while to figure it all out, frankly.
Yeah. Well, I know you have a fund, et cetera. So, tell us a little bit about the fund because I know that fund's rocking. Tell me a little bit about what you have going on.
Yeah, so it's a diversified real estate fund centered in housing. I mean, my entire career is about housing, and I told this to my team actually at our Monday morning meeting, just expressing gratitude for we're all out here doing real estate, we're all making money, but at the end of the day, what we do is provide housing,
Mm.
right? And not to get too esoteric, but on a fundamental, that's a human need, and we do a great job at managing it, providing it, building it, operating it, and creating it for others. And that's something we don't take lightly. And I'm
Mm.
honored personally that that's been my career in real estate is to be a guy centered in housing. Now, do we own some industrial warehouse and parking lots and various other holdings like that? Sure, but our investment fund is centered in housing. So what do we mean by that? It's basically got three. It's a three-pronged approach. Number one is multifamily. That that's what we focus in. We've done close to 700 million in multifamily,
Mm.
um, and and so that's a big part of the portfolio in terms of stability. Mostly A and B class assets, 2000s and newer. Sort of stable yield, value add, preservation of wealth, irreplaceable assets and locations. The second one is what my background was in terms of where I came up in the world and quote unquote made my money, which is development. I was a
Mm.
single family housing developer. So we have a land development
Mm.
vertical right now as well that I've had for 20 plus years, but it's been incorporated into the company a couple of years ago, where we take raw land, get it entitled and approved and ready for development. And then with forward contracts with national home builders, we put in the roads and infrastructure and then sell the finished pad sites off to the likes of the Leonard, Taylor Morrison, D.R. Hortons of the world. And the third prong is RV parks, campgrounds, marinas, a world that we affectionately called outdoor hospitality.
Mm.
And
Yeah,
so
that's a
that
good
would
one.
be
That's a good one. Yeah.
yeah, outdoor hospitality. Well, it is a hospitality business, right? They
Oh.
function on ADR.
Yep.
It's really run like a hotel or a hospitality business. So
Mm-hmm.
that's why the moniker sticks. But the land development, of course, is total return, right? There's no cash flow, but we give off big 30, 40% pref returns in our land development stuff. And so that's the total return component of our diversified fund. And then the outdoor hospitality is there for cash on cash. I mean, these things are 12, 13, 14% cash on cash yields with
Mm-hmm.
still, 20 plus percent IRRs on it. So we really like the asset class. We're partnered up with a specific operator out of Colorado that really gets it and understands the asset class and is a fantastic operator. All about the resident or the user experience, if you will, for the hospitality assets,
Mm-hmm.
and so that's why that's in our fund is that we really like that as a burgeoning asset class.
And you mentioned some huge rates of return. Now, help me to understand. I know nothing's guaranteed. Let's remember, and people should always go back, talk to their advisor. Give us a call or whatever. But
Of course.
give us a little bit of an idea about that, because I like those numbers. Give it, open the drapes a little bit more so I can understand that.
Yeah, so multifamily, especially now, this day and age, multifamily is commoditized. It's a commodity, all right. And anybody who doesn't see the business that way, I think, is missing some fundamental understandings about what the market forces are and the amount of capital that's in it.
Mm,
So multifamily is a commodity, and you're really, to me, it's a preservation of wealth play, and we're getting 5, maybe 6, maybe 7% cash on cash yields on multifamily
hmm
assets. Your total IRR metrics for a given 5-year hold are likely going to be 14, 15, 16%, maybe 17, 18 if you're lucky, right? But you're in
hmm
that kind of mid-teen IRR, stable, sound, solid, nothing too great, nothing too horrible, stable yield. And that's why
hmm
we'll always be in multifamily, is we like the tailwinds, and we like the stability.
hmm
So, the total return play for land development is massive. But depending upon the deal, it's between 30 to 40% annualized return, and we pay that as a pref return, right? Meaning before the fund can get profit, the investment vehicle pays the pref return to the fund before the developers of the asset can make a dollar. And
I think
so
people like that. They're getting the money first, and then everyone else afterwards.
you got it. It's a
Yeah.
fantastic, and it's a huge yield. So people are saying, how do you do that? And well, look, I've been doing it a long time, right? So I know structures. And mostly, what I've learned is that how you structure deals is more important than what you're actually doing. How you
To a certain
structure
extent, I agree with that. Yeah, yeah.
sets you up for success or not, depending
hmm
upon how your structure is. And so we set this investor forward structure up on our land dev because we're number one, we've mitigated the risk, right? So I don't take investor dollars in until we already have a forward contract with a credit risk counterparty like a DR Horton, Lennar, Taylor, MI, et cetera, where they have signed a contract to take out the lots and given a deposit to be used in the cap stack before we take an investor monies, close on the deal, and do the development.
That
That's
must
what we're.
mean okay. Hold on. So that must mean you're putting in dough. You or your semi partners are putting in dough, because otherwise, how would you be able to afford that?
Yeah, we put up all our own capital to take them
There
through
you
the
go.
entitlement phase, get a development ready project. We take money, investors' money in after it's got a development order on it. Yeah.
By the way, yeah, I hear it. Someone told me that I forgot his name. It was a big company. It's one of the. He said that the real money to be made is in putting in the roads, putting the infrastructure, and then they're out. What are you? Because yeah, what are your thoughts on that?
My thoughts are that that's exactly what we do. So yeah,
Uh,
that's where the money is, right?
but
Because here's how it works: the national home builders, they're publicly traded companies. They have quarterly earnings that they need to adhere to and that they are beholden to, and they can't keep too much on their balance sheet. So we basically serve as off balance sheet development partners to them, hold the
mhm,
land. We're like a land bank partner, right? So they have a contract, they have control rights on the land. They're going to buy it from us, but we're actually closing on the land, putting in the
right.
roads and infrastructure, doing that work, taking on that construction development risk, and then delivering them a finished pad site so that they can monetize foundation to finish and then sell it through, and lease it up, whatever they're going to do with the. But it's on their books and then it's quickly off their books and it's
Yeah, I
into,
get it.
an income stream. That's what they care about.
So what? I guess I should have closed the point on that. What rate of return would you get? And this is a dumb question. Would you guys get, even though you're coming so early at the infancy, versus someone else, someone who comes in afterwards? And I know it's a hard question, but I'm just wondering. Like,
Yeah.
uh, hmm,
Yeah, that is a hard question because
I
we
know.
do, we're a unique animal in that we
Yeah,
take raw land, which is worth, it depends right on the location, but let's just say $100,000 an acre, just
yeah,
to use some easy math. And then we go through a 9 to 12, something 18-month process with our own money, getting it entitled and approved, doing all the engineering, doing the zoning, doing the PUDs, doing whatever we need to do to get it fully shovel ready and have a development order. And then when we have it completed, it's worth 300,000 an acre, right, or more.
mhm.
Sometimes even much more. Um, But then putting in the roads and infrastructure is a huge value add play, right? And so we're taking on construction risk, and we're taking, but it's still in the multifamily world we come from, it's still small, right? I'm still taking 10, 12, $15 million, construction loans out to put in this infrastructure for a typical development. And we're getting millions and millions of dollars in profit over and above what those hard costs are for doing that. And that's why we're able to give those types of returns to investors.
I get you. Oh, dude, I totally get it then. Yeah, so it snowballs. Yeah, okay, very interesting. Now I get it. And what other? And you have how many funds total do you have? I bet you have stacked funds. How many funds do you have total?
Well, no, right now it's just the one fund, Diversified.
Oh, is
So
it?
that fund is diversified into those three different asset classes. We'll invest in no less than 15 or 16 different assets. So true diversification across those asset classes. And that's why we think it's a great premise and a great investment thesis in terms of, again, sort of stable yield, multifamily, total return land development, and cash
Mm.
on cash play from the RV Park campground marinas. So we feel like it's a
Mm.
great blended return. You make a, for some folks, you make a single investment and you get this diversified hedge and
I
risk
see.
mitigation, and you get access to these different asset classes that are producing an asymmetrical blended return across the profile.
Yeah, it is blended return. I get you. All right. How did you get involved? Yeah, that's a legit question. How did you? No, what you were born, and
I
then
was.
you are where you are. Give us a little bit of background because you have an interesting background. Plus, you're a Dave Matthews Band fan, so kudos
Yeah,
to you.
buddy. Yeah,
Yeah.
man. Seen him
Um,
many times. One of the very few concerts, I think three different concerts now that I've taken my wife to, where she actually shed tears. Just
mm,
true overwhelming experience of, wow, this is beautiful. She's not a DMB fan. She wasn't like that. There was no illicit substances in her blood. It was just truly like feeling like the music, and being like, wow, this is beautiful. So that's my DMB rant.
thank you very much.
So my story is, started, born, south of Boston in Massachusetts.
Yeah.
Got degrees in forestry and wildlife biology, which is
Huh.
rare and weird.
Yeah.
But I went out west, went to Colorado, Idaho, Montana, California, worked for the U.S. Fish and Wildlife, worked for the U.S. Forest Service. And that's when I discovered I had a calling for real estate. So I was working in land, right, and managing forests and doing all of that. But I realized that my upward trajectory within those public organizations were going to be severely limited, and it wasn't my true
Mm,
calling. I was called to real estate. I don't know how else to say it. I was
mm,
literally just felt this calling to be in real estate. And so I ordered an online course and started to educate myself. I think it was Carlton Sheets, No Money Down, because
uh,
I'm advanced age. I get some grays there with you. And so I started wholesaling contracts and buying single family and rehabbing houses and doing that
and
for
when was
about,
that? How many years ago? How many years ago was that?
that was late 90s. So
Okay.
25 years ago, 26 years ago, 27 years ago, actually. Geez.
Mm,
97, 98, I think, was when I actually ordered that course.
wow.
And did my first wholesale contract, started doing single family, got into rehabs, found that I loved construction,
Huh.
absolutely loved it. I loved that process of transmutation and of creating things. And so I moved back here to Cape Cod, and got in. I got my broker's license, and I was selling real estate too, and making money on wherever I could, right, in real estate, but also was doing this house flipping business.
Hmm.
And so really moved up to New Hampshire and started a general contracting business, and really started building rehab
Hmm.
homes, starter homes, middle market homes, and then I got into sustainable homes, green net zero homes. Then I got into multi-million dollar, luxury homes on the lakes and oceans here. Um, and then I got into community development, right? Doing what we're doing now in this vertical, but we would do it the cradle to grave. Take raw land, get it entitled, approved, put in the roads and infrastructure, build the housing, get the real estate agents in, sell the community out, and move on. Did some mixed use projects, some condo developments, et cetera,
Hmm.
but always was buying income producing assets the whole time. So I was taking the
Hmm.
cash I made in those businesses and buying multifamily assets, again, some industrial, some office, some warehouse facilities here and there. but mostly 90+% multifamily has been where I
Hmm.
put all my wealth and grew it. Um, and so built some fantastic holdings here, sold all that off 17, 18, 19, sort of felt like the top, and then really started looking at how am I going to grow and expand myself in the next phase of my career. And it was going to be down south, Texas, Florida, Carolinas, growth markets. So we really started to build our team and infrastructure in those markets, get local knowledge, boots on the ground, started flying there monthly, and really got to know these markets intimately. And that's where our team is based. And that's so even though our corporate offices are here in Portsmouth, New Hampshire, we're always flying. I was in Florida last week. My business partner's flying to Texas next week. And all of our team, all of our employees, all of our business partners are all in Texas, Florida, Carolinas. And so we're really hyper focused in those markets, because that's frankly where all the tailwinds are in terms of population dynamics, demographics, job growth, pop growth. And so that's where we want to be. New England's kind
Yeah,
of small,
I was,
and it's going to stay stable.
that totally makes sense. I was wondering why you had so many projects down there, but it makes sense if you really think about it at the end of the day.
Yeah, that's where all the demand is.
Yeah. Yeah, yeah, and the opportunity for people like you, and therefore the opportunity for your clients, make some dough at the end of the day.
Yeah, yeah, exactly. That's right. Yep.
Yeah. All right. So okay, now I get it. Now I understand your background. That's a big jump from forestry to real estate development, as I see it. But it's worked out.
Yeah.
For your clients. So tell me a little bit about the structure of the fund. Who knows? Maybe there's some people out there who want to start a fund. More than anything, there's probably some people who are going to be wanting to hear about your fund. Maybe who knows? Invest in it.
Yeah. So we structured it as a Reg D 506C, which
Mm-hmm.
is accredited investors only. And one of the so obviously the diversification in it is a bit unique. Usually people set up a fund and they're like you said, stacked to each a different asset class, sort of clear on each opportunity. And ours
Exactly.
is very clear on the opportunities. It's just that we have three different asset classes that we've combined into one for a diversified portfolio that we think makes sense. So as I've you know gotten more and more wealth and money through the years, I've really started to understand diversification better, right? And so I don't have all of my eggs in one basket, even though I'm
Uh,
still mostly a real estate guy. Mostly everything that I do is in real estate and real estate verticals and investing in my own businesses and such. I still diversify into a number of different assets and holdings. And so that's the premise that we wanted to bring that we felt like was perhaps a bit missing in the market, where people are syndicating one-off deals. And so if you put, 100 grand into one syndication deal, if that deal goes wrong, you have 100% loss
you lose it all.
happening,
Yep.
right? If you have invested against 16 assets, you have a 1/16th loss, right? And so it's easy to do the math to know that hedging that risk and diversifying into a whole slew of different assets is simply intelligent. That's why big money does it. That's why funds do it. That's why billionaires do it. That's why all intelligent fund managers uh, diversify and have true diversification like that. So we wanted to bring that to the market and explain that to people, but we also needed to do it where we had a track record, where we had experience, and where we know and understand things. So of course it's real estate and housing based in those three verticals that we already talked about. The other thing we did in the fund that we feel like is perhaps a bit unique is we set up four different tiers, right? So you've got 100K investment level, and then another tier is a 500K, and then $1 million, and then a $5 million investment level, of course, because we want to incentivize larger investments. So what happens is we have bigger waterfall splits as you go up in those
Mm.
tiers, right? So it starts at, say a 70-30 at the bottom, but by the time you get to the top, it's a 90-10. And
Ooh.
so that waterfall return is massive to larger investors that are going to allocate more capital in. We're trying to attract some fund of fund investments,
Yeah.
some RIAs and some family office groups that are willing to allocate at the $1 million, $5 million level, but also create tiers where if you were going to invest 250,000, maybe you would consider jumping to that 500K level because it's a substantially different waterfall, all having the same 10% preferred. So we did a higher pref rate too. So there's a 10 hurdle before we see a dime,
Mm.
and then the waterfall structure kicks in thereafter.
Yeah, I like the 90-10 split if you're, putting in 5 million or above. And I get it. If you bring in a fund of funds, they're, splitting a pretty good amount, their clients are going to be really happy, and you guys are happy because you're getting an absolute number that's still pretty good.
Yeah. So we're talking to folks who, again, have their own fund and they're raising their own fund
Right.
of dollars, which have 100K investors. But each one of their 100K investors is going to get the 90/10 because they're trying to get to the $5 million level in their fund so that they can allocate in at that point, which then feeds all those returns down into their fund.
Mm-hmm.
So it's a fantastic play for folks who have their own funds and fund to fund investors.
Yeah, we only have a few clients who have fund to funds, but that's good to know. I mean, who knows? Maybe someone's going to hear about it out there and think it makes sense. By the way, how does someone get a hold of you? That's kind of important.
Yeah, so our website is easy to get to, hampshirecap.com, Hampshire CAP. You can look me up on LinkedIn, Shane Carter NH. That's probably another great way to reach me, Facebook, etc. Or just come over to Portsmouth, New Hampshire and hang out. We'll probably run into each other.
All you have to do is, Shane, yeah, I'm over here.
Yeah, there's only 7 of us, so just come on up.
That's good stuff. So let me ask a couple more things about. Well, actually, what about New Hampshire for investing? If there's only a few people there, what about New Hampshire?
Yeah, New Hampshire's interesting, and obviously, we've owned stuff here. We still own some assets here, of course. It's just small, right? It's just a small place. There's 1 million people here in the entire state, and go into a Houston where there's 8 million, or DFW, and it's just it's mind-boggling the size differences. So frankly, there's just not as much opportunity, and because of that, you have illiquidity, right? So there's literally a lawyer back when my team was sort of calling around to different folks, and he owned I think it was like a 78 unit multifamily property in one of the towns around here, and he called him up and he said to my acquisition guy, "Do you know what my license plate says? It says NVRSELL." Never sell. The mindset, right? They'll never sell, and they just pass it on generation to generation because there's just not enough assets. And so if you trade it, what are you going to buy? Because no one else is selling. So there's an illiquidity as well here that just simply doesn't work for our capital growth program.
Yeah, and that it also shies away from your idea of focus, because at the outset you said focus is going to, the number one tip you'd give for a real estate investor. I think that makes a lot of sense. You have to be reasonable in doing so. Being diversified makes sense, but also if you focus on whatever, like what you're doing, it totally makes sense in the whole scheme of things.
Yeah, that's exactly right.
Yeah. All right, I have a couple more questions for you then. So actually, let's go back to Texas. Because I just got off the phone with a client in Texas, and one of his concerns was, well, everyone's going in there, but now is it at its peak? By the way, he was from Texas, and he's thinking about moving out, which is kind of funny. But anyway, what are your thoughts there?
Yeah, look, I love that. I love Texas, by the way. If Texas had an ocean, I'd move there. It's a fantastic state. So everything in real estate is always hyperlocal, right? Everybody knows that. Your audience knows that. Everybody knows this. So we focus mostly DFW. We've got assets in San Antonio. We've got assets in Houston, and nothing in Austin. And so, where is it overbuilt? Where is there too much? Where is it overheated? Is it at the peak? That is a hyperlocal question. And so when we look at, within, think about it, DFW is one of the main markets that we focus in where we buy assets. I mean, we're talking about not everywhere in DFW is a great place to buy, right? Yeah. Obviously. And then where is the development occurring? Where is that bleeding into pressure in existing assets? That's where the pain is being felt. Now, where are there assets that are irreplaceable, where there isn't development pressure, where there's an opportunity to pick them up because of some type of duress or stress, which personally I believe is going to start. We're already seeing a bit of it happen here, Q3. It's going to kick in a little bit more next quarter, Q4. But by the time we get into 25, Q1, Q2, that's when we're going to see it, right? Where the stress, duress, et cetera, the extend and pretend, that's when I think it's mostly going to start to play out. And even then, we're still going to say no to 99% of every deal we see, which is what we do, because we are hyper vigilant about picking the right asset in the right location that is simply irreplaceable. And so I don't like to get into these sort of top level discussions of, is it overbuilt? Is it at the peak? Is it a falling knife? I kind of take the approach of almost like dollar cost averaging, right? Where if you're buying fundamentally sound assets
Oh,
at a really amazing basis, uh, and you're leveraging the current interest rate environment and you're buying intelligently, then buy it, and it's a good buy. And don't worry about if there's still price dropping that could still happen, or whether we've actually hit bottom and are we going up. If it's a really good deal, then it's a really good deal, right?
mm,
And so that's sort of the approach we take. But frankly, we still say no to 99% of everything we see, and we're seeing a lot of
mm.
things that are seemingly good buys today, but we still just don't like it. We don't like the metrics. We don't like the long-term play. We don't like the actual real estate.
Well, what does that mean for invest? I mean, here I was just talking to a client last week about this, so that's interesting. You just said that, but he was saying that I don't like investing in funds because even if they don't like some of the deals, they have to invest in it because they have to deploy their capital. But what you just said is
Yeah.
pretty interesting. What are your thoughts on
Yeah.
that?
Well, we don't, that's a great question. We've got a very large family office group that we've been courting now for the last few weeks.
Uh,
And they asked that exact same question. Hey, aren't you going to have this sort of money burning a hole in your pocket that you're going to need to go out and
right.
deploy to produce returns on? And so what we're doing for folks who are into the fund is we're just it's in a money market, and they're just getting that yield and they're getting that return. Now you could do that on your own. Yes, of course.
Right.
But we're just saying to folks, look, we're not going to come off of our investment mandate and our investment thesis, and just because we have 10 or 20 or $50 million sitting there, it's not, we don't care about that. That's not going to change how we look at assets and how we look at deals, because that's my money in the fund too, right? We put a minimum of 5% of our own cash into
Mm,
the fund and into every deal. So these are my
mm,
investments. This is my money. This is my portfolio as well. And I'm simply not at a place in life where I'm interested in taking risk and losing principal. I only want the best deals, and that's the only thing that our fund's going to invest in. It just takes a process of getting to know each other to understand, so folks understand that, okay, yeah, Shane's serious. He's right, and he's putting his money where his mouth is. And we can show you our deal flow. I can show you the underwriting, the acquisitions team, and what they look at on a weekly basis, and all the deals that we throw in the trash.
yeah, so you're the real deal. So if you're really putting up five, and I believe you are, you're putting up 5% of the assets plus you're staking the fund basically with your own money. I mean,
Yep.
that's the real deal right there.
Yep. Yeah. Our trajectory is to be multi-billion-dollar fund managers here in the next 5 years, and to continue to grow our fund management capacity as we again, we're always going to be real estate focused and
Hmm.
alternative asset managers, but to be able to really get to the next level of attracting institutional capital from the big Boston, New York, and other firms. You have to be diligent. You have to be institutional quality, and so that's our mindset from the get go.
Wow, you're legit. If you want to get that big, you want to make a real run of it. Wait a minute. So wait a minute. A little off topic, but RIA. You're trying to get money from RIAs and broker dealers. Is that what
Yes. Yeah.
and you have all the license. Well, yeah, you already have the Reg D, all the licenses for it, etc.
Mm-hmm.
Look at you. Oh, look at you. I might have a little referral for you there, buddy.
You got to do things the right way, Kenner.
Yeah, yeah. You're also looking for traditional bank financing, I think, from at least at times, correct?
Oh, absolutely. Yeah.
Yep.
Yeah. Of course. Yeah.
Okay, I like that. Well, we're gonna have to land this plane here. We've been talking for about 28 minutes. So, how about this? What's one thing we have not talked about that you think can add value to a real estate investor or people who I've already talked about who would be listening or watching this?
Okay, so look, there's this whole other side that I've been going deep into in my personal life. I'm a big fan and believer of balance, right?
Hmm.
And I'm finishing up this book. I'll release it probably next month. Just fine tuning it. It's called Optimize Your Life, and so it's really about again understanding professional success, um, and then health and wellness. I'm a big health and fitness guy.
Yeah, you look like it.
Spiritual.
You look really well fit. Yeah, good job.
Right on.
Yeah, there you go.
Spiritual wellness and then relationship wellness, and how that all comes together to really actually form a truly fulfilling life. So what I see a lot of and what I've seen a lot of in my life are very wealthy people who are very unhappy. And I swore and promised myself that I would never be that guy. But
Mm.
I didn't know why they were unhappy. And I didn't know what I needed to do to get happy. And so when to me, I love talking to people about that because it was an epiphany, and everything that I was doing wrong, spinning my wheels in my 20s and 30s, I changed in my later 40s, and now in my early 50s, I'm becoming better and better at, which is this true health and well-being of a total view of
Mm.
how life should be. And that's why I make more money now, have better relationships, and work less.
Look at you. So actually what we should be doing is talking a month or two down the road when your book comes out. Because, I mean, what we've talked about has been really good, but it sounds like that book's going to be kind of a groundbreaking type of book.
Well, it's at least I appreciate that. I hope so, but it's at least just me sharing what I've learned so far in my journey. And if it helps others, that's my whole intent. Is that I just want to help others stop spinning their wheels and give them a bit of a inspiration light bulb to say, hey, maybe I should think about this whole thing a little bit differently.
Yeah, dude, I like that. Wow. Yeah, you're a good dude. Really are a good dude. Not only because you like Dave, but also you're just a good dude. Seriously, I'm serious. I'd love it if you came back right as the book's being released, and we chatted about that. It sounds like that'd be a worthwhile conversation.
It would be my honor and pleasure. Absolutely.
I dig it. Once again, how did someone get a hold of you?
HampshireCap.com. You can find me, Shane Carter NH, on LinkedIn, Facebook, et cetera, et cetera.
Awesome. I really appreciate it. Guys, hey, everyone who's been watching, listening to this, totally appreciate you guys spending the time hanging out with us here. Once again, my name is Kenneth French at vastsolutionsgroup.com. And also, you've been listening to The Vast Voice, telling business secrets to entrepreneurs. Thanks, everybody. Dude, that was good.